once it starts streaming, yes, this meeting is being live streamed. Nice. Let me also report. Nice. Let me also. I hope my screen is visible now. You can all see my screen.
Yes, it is.
Yeah.
Hello? Am I audible?
Yes, you are audible.
Okay. So I'm saying international tax as we see it, it's not something different, okay? It is something you already know, okay? It is how our domestic laws, okay? Let's say that if I've gone to invest in Nigeria, you see that I have paid some taxes in Nigeria, right? And I'm a Ghanaian. How do the two tax laws interact? Meaning that definitely you'll be affected by Nigerian tax law, no be so? And then when you come to Ghana, because you're a resident of Ghana, you also be affected by Ghanaian tax laws. Now, how do we interact as two different countries regarding the transaction that you have made? That is international taxation, okay? Tax internationally. Not that there's any particular international tax law. There's no international tax law anywhere, but the interaction of various domestic systems. That is what we call international taxation. I hope that makes sense to everyone. Is it understood? Is it understood?
Yes, sir.
Yes, sir.
It's understood.
Yeah, Sylvester, your hand is up. Sylvester Ofori, your hand is up, please. Do you have any question for me? Sylvester, I think your hand was up. So as I was saying, international tax, right, is therefore referred to as the international aspect of our income tax laws. I get it. So if I take Ghana, anything in our law that covers international transaction is actually international tax. So international tax, if you want to be a good international taxation expert or international tax expert, you need to think about two things. Anytime you are going to tax someone, right? International tax stems from two broad dimensions. So there are two broad dimensions of international tax, right? So the broad dimensions of international tax, I said how many? Two. And the thing is, it is either you are taxing, are you getting it? You are taxing resident individuals on their foreign income, okay? So taxation of residents on foreign income, okay? That means it makes it international, right? It means that this guy went to Nigeria to make some money. So you are now taxing this guy on his foreign income, or you are taxing what? A non-resident, somebody who is not Ghanaian, are you getting it? On his what? His domestic income. Do you get it? I hope this makes sense. And you see, it all looks international. So it's either Mr. Chance has come to Ghana to make some money, right? And then Mr. Chance is not a Ghanaian. So we are taxing Mr. Chance on income, which was what? Made in Ghana. Or Kofi Ajimai is a Ghanaian, but he went to UK to make some money. We are taxing him on that foreign income. I hope that is okay. So in simple terms, when we tax a Ghanaian in UK, international tax, or we tax a non-Ghanaian in Ghana, still international tax. The two broad dimensions. So every question that will come in your exam is either we are taxing a resident or we are taxing what?
Non-resident.
Or we are taxing non-resident, right? If you get it like this, then you understand. So there's no international tax law anywhere or international tax court. Taxes are not international, right? So there's no international tax court or any administrative body for international tax issues. All taxes that are levied are under a specific domestic law, okay, either by federal, national, or local government. So these tax laws have an impact on cross-border transactions. And international taxation governs these domestic tax rules under their customary international tax law and their tax treaty. So there are some things that have been accepted as the normal over time, right? And these things are customary, okay? So when we get into interpretation of tax treaties, you understand the Vienna Convention on the Law of Treaties. So all treaties have a way we must interpret them in good faith, okay? These are customary practices that have been inculcated into a legislation or a regulation. Do you understand? Are we okay? So in basic terms, we are saying that if we look at the various aspects of our tax laws, that is what we call international tax. So if you look at our Income Tax Act, okay, we look at Section 3, which deals with assessable income, right? Which deals with both local, it deals with residents and non-residents, meaning these things are all covering what? International taxation, okay, both local and domestic. And you see that I told you that there are two broad dimensions. If you want to become a master of international tax, you must understand that anytime you are taxing from two major dimensions, right? And these sections that we have seen in our Income Tax Act, Act 896, and portions of our Revenue Administration Act help us to deal with international taxation. Though there are other laws, okay, other tax laws which are not, but these are the main laws that we will be dealing with. That's why this is what you see on my screen. I hope that is okay. So we go into our Income Tax Act. There are various aspects, but there are specific areas that the law actually calls international tax, and it stems from here, okay? These ones, from Section 101, okay? That is up to 113, okay? That is what your law calls international tax. But these areas that we see there are also used to deal with international tax avoidance evasion. Okay, so it's part of international tax. I hope everybody is following. So one thing we must know is that the main premise is that so far as there's international tax, then there's income. Okay, somebody must have an income for it to be taxed internationally. It must be cross-border, right? Cross-border transactions are simply what we call international tax. I hope that is okay. So with that being said, we are just going to look at why these things are important, right? So these are the broad dimensions, and these are the things that goes into international tax. So you see that I told you that in the Income Tax Act, Section 3 talks about assessable income, and therefore assessable income would be captured as what? International what? Taxation. Do you understand? I hope that is okay. So what is assessable income? Under Ghanaian tax law, we say that what? Assessable income is all your income from employment, business, or investment, irrespective of if you're an individual, irrespective of whether the source of that income has ceased, meaning this connotes what we call worldwide income. It means that so far as you're a resident of Ghana, anywhere your income comes from is taxable in Ghana, irrespective of whether the source has ceased or whether you earned it during the year or whether you earned it from elsewhere, it is taxable in Ghana. So that is what we call what? A global tax rule or worldwide taxation. So there's a simple rule when it comes to taxing international transactions, right? And that means you have to look at what we call what? The taxation systems or the systems of taxation. Some people call them bases of taxation, right? So you have to understand the systems of taxation. So there are two major systems. However, there are other ones too. That's why I said two major systems. There's the draconian system, there's the lifestyle tax system, citizenship-based taxation. There are a lot of them, but the two main ones are the basic source, the basic connecting factors that began all this. And those are the principles of residence, okay, so which we call the residence system of taxation. Okay, so we have a residence system, which mostly we call the worldwide taxation. I hope you are writing something down. And this is the premise you use to understand international tax. So the resident system, which we call the worldwide taxation, okay? And then we have the source system, okay? The source system, which we also call the territorial system. I get it. Or some people consider a mixture of this, which is a hybrid version, right? And this hybrid version has both residence and source. And you could say that now almost most countries in the world now have this one, okay? They adopt a hybrid model where they adopt the territorial system, part territorial and part residence system. Are we okay? So that is what this entails. So we are saying that anytime you are looking at these systems, this system will determine which income will be taxed in those two dimensions, right? So when we talk about the worldwide taxation system or the resident system, we are saying that so far as you are a resident, right? So residents shall be taxed, they shall be taxed on their worldwide what? Their worldwide income. Okay, so with this one, we are saying that all income that you earn all over the world will be taxed. I get it. In your resident country, worldwide taxation, so your worldwide income. So you are taxed on your global income or your worldwide income. If you come to Ghana, right, you are looking at your income that, let's say, income that comes from a foreign source. So any income that will come from a foreign source means what? You brought it to Ghana, true or false? True or false?
True.
False. True. And any income that was brought into Ghana means it does not have a local source, right? So if you have income brought into Ghana, it means it has a foreign source or income received in Ghana from another country, right? A remittance. Is it not also having a foreign source? Now, if you come to a domestic source, income that has a domestic source, right? It is either income which is what? Accrued in Ghana, okay? Income that is accrued in Ghana, or income that is derived from Ghana. You get the idea? So though we are talking international, you see, I'm bringing it to something you are familiar with. So if the income is brought into Ghana, it means it came from somewhere. If it's received into Ghana, it means it came from somewhere, right? So brought into means you brought it yourself. Received it means it was sent to you, right? These ones means they have a foreign source. But if you are a resident of Ghana, all incomes that you receive, I get it, or bring into Ghana will still be taxed in Ghana because I told you with the resident system, what happens? We tax you on what? What did I say about the resident system? We tax you on your worldwide income. So it doesn't matter where you go or where you are coming from. All your income will be taxed. But somebody may ask, okay, so does it mean that if we have Kofi, right? Let's say we have Bra Kofi here, right? And Kofi went to the UK. Kofi made, let's say Kofi made £100,000, right? And he paid tax at 20%, meaning that he would have paid tax of what? £20,000, not so. Now, this £20,000, meaning that Kofi will remit a net income of how much to Ghana? That's £80,000, true or false?
Yes, sir.
Now, this 80,000, you see Kofi was taxed, right? Now, if Kofi comes to Ghana, this is Ghana. If Kofi comes to Ghana, this same money he brought, right? Not the 80, we always assess on gross basis. Why? Because this is the actual income you had, right? So this is what Kofi, when it comes to Ghana, Ghana will still assess Kofi on what? The same 100,000 and tax him using Ghanaian tax rate. So let's say that Kofi is an individual, we have to use a graduated tax rate, but let's say the tax rate is 25%. You get it? So Kofi will pay how much tax in Ghana? That's 25,000. True or false? But you know this is not fair. Can you say it's not fair? Because Kofi has paid 20,000 in UK already. Why should Kofi come and pay 25,000? Meaning that his total tax liability is about what? 25,000 plus what? 20,000. Not be so. Meaning Kofi has a total tax liability of 45. And you know, this is what we call double taxation. So this makes people evade taxes or hide their taxes. That is why somebody will travel, you not even know where he went. He will not even disclose to you. because he doesn't want to pay tax twice. That is why we are learning this course. So apart from this thing that we are seeing, right? You see that Kofi is there for what? Tax on his worldwide income. Why worldwide income? All the income that Kofi will still make in Ghana will be taxed in Ghana together with this foreign income. Yes, Edwin, you understand?
Okay, Prof. Sorry, I wanted to ask.
Yeah.
The foreign was brought into Ghana and received in Ghana. So
Yeah.
does it mean that if you make the money and then you spend over there, it won't be taxed?
It will be taxed.
Okay.
The nature of it is that this brought into Ghana and received in Ghana are still components of income that you earn during the period. Okay. So let's say even if I didn't bring my money, it is still considered brought into Ghana because I earned it in the foreign country. And as part of your assessment, it's part of what? Your global income. But you know the funny thing? How will the tax authority know that you earn some cool interest in some bank account somewhere? You see, until you disclose, you get it. So practically, these things sometimes, if you do not have strict control over your borders in a country or have good residence system, it will be difficult to track people who actually bring. Look at the number of people who travel outside and into Ghana. Are you sure we know how much they even earn? Please answer my question.
No.
So some of these things you need to know because when you go to jurisdictions that they exercise tight control over their borders, you can track these things. Edwin, are you okay now?
Yes, I'm okay, Prof. Thank
Okay.
you.
So now we have something. Now double taxation has happened because one country says you made money there, right? Another country is also saying that because you are resident in their country, they must also tax you. Yes, Oscar?
Yeah, Bill, the foreign income received in Ghana, does it mean anytime anybody transfers money to me in Ghana, I'll have to pay tax on it?
So far as you are resident, it is money that
No.
was earned by you. Okay,
No,
so if
not necessarily, not earned by me. Maybe somebody, a relative transfers money to me that I have received.
those kinds of money, we still assess the nature of the income. If it is actually income, do you get it? Some are not income, but it may be a gift. And gift, you still have to pay tax on it at 25% now. Unless it
Okay.
came from, for family members, it's exempt. It doesn't become a taxable gift. You get it? So that's why I said, you see, though what you are saying is international, I'm still bringing it to local tax. Because once the money comes to Ghana, it becomes what? Your money here. You get it? So it is the local law that you get, right? So let's see something. Please hold on. I'm just showing you something just with what Oscar said, just to get an idea of gifts. Gifts. So there's something simple which I want us to look at. Please, I hope we are all following. I'm looking for a question for you. Please hold on a little for the best soon. Okay. So so look at this simple question, something like this. I hope you can see my screen. Pastor Divine was transferred from his station at Kumasi to Axim on 1st September 2017 after 10 years pastoral service in Kumasi. The underlisted gifts were given to Pastor Divine and his wife, Prophetess Peace, during the send-off party. Now, you can see that his daughter in France, Pastor Divine, right? He received foreign currency. Oscar, is it similar to what you were saying?
Yes, please.
So you see now, though this is foreign currency, it is still received in Ghana by Pastor Divine. But the question is Pastor Divine a resident or not a resident of Ghana? He is a resident, and this constitutes a gift. But who did it come from? Gifts have particular rules which you have to follow to tax, right? So you realize that I wrote the following gifts are exempt, right? The gift of $1,000 from his daughter in France will not be taxed because gifts from your immediate family are not taxable in Ghana.
Okay.
I hope it makes sense. So you see, though it's international, you are still taxing it under a particular law. International transactions are still governed under domestic law. That is what you must understand. I hope we are all learning something. So international tax, there's no international tax law anywhere. I get it. When we say international tax law, it's just the two dimensions that we are taxing the person, right? The interactions of various domestic tax laws. I hope that made sense and we are all okay. Are we all okay now?
Yes, please.
Yeah, we are fine.
So let me take this off. So did we understand the residence system? So for Ghana, any income that you bring to Ghana, are you getting it? Or you receive from a foreign source will be subject to tax where? In Ghana. Is it understood? Now let's go to the territorial system. The territorial system is the second type, which with this one, we only tax, are you getting it? The country only taxes, are you getting it? Income that was earned in its territory, okay? Or that has a source, okay, in its country. Okay, that is why we call it territorial system. So we are saying that if only you make money from my country, that is when I tax you. It means any money that you bring from any other country to my country, I do not tax you. Does that make sense? So it means that, okay, this is territorial because mostly this applies to non-residents, okay? When you are looking at it. So non-residents, assuming you are going to a tour in Ghana, you are coming from the UK, or let me use a different country. We are all Ghanaians, right? Now we decide to leave to a different country, or let's say we are going to Italy, and then we brought our own money, maybe 50,000 euro. And then immediately you get the Italian authorities tax you. Will you be happy? Will you be happy?
No.
Why? Why won't you be happy with the Italian authorities?
And because it's your money that you brought from your country.
Yes, because there's no work. You didn't work, right? You just brought your money for tour and they caught you and taxed you. It is discrimination, right? It is discrimination. You wouldn't be happy. You wouldn't even want to go there again because why? I didn't do anything. I brought my own money and I taxed it. Yes, that is why for non-residents we only tax them on income which has a source in our country. I hope that makes sense. So this is what we call what? The source principle of taxation, or the source or territorial system. So I hope you've got the distinction. With worldwide taxation, we tax you on all your incomes, irrespective of where it was earned. And when we talk about a territorial or source system, I get it. We only tax you on income which has a source in your country. So when you come to Ghana, non-residents will only be taxed on income which has a foreign, which has a what? A local or domestic source. And which of them has a domestic source? We only tax you on income which was what? Accrued in or what? Or derived from Ghana, right? So these are the only incomes which we can tax what? Non-residents on. And apparently, I told you that most countries do not run only one system. They run a hybrid. So when you come to Ghana, non-residents are taxed on only source income, right? Domestic income, and residents are taxed on worldwide, right? And because these two systems clash, okay, it creates what we call double taxation. And double taxation is the main reason why you are learning international tax, how to deal with double taxation. I hope that is okay. Are you gradually getting it? So we are going to do a simple exercise, and then we are going to see if you can actually tell me. So we are going to create a table, and then we are going to look at the source, the income, okay? The income, the source of the income. Then we are going to bring residents and non-resident, right? And all I want you to do is fill in. If you are going to tax, you tell me. If they are not going to tax, you tell me, right? It's a little exercise you are going to do. Okay, so let's look at income brought into Ghana. Income brought into Ghana. What is the source? Is it foreign or domestic? I want you to answer. Foreign or domestic?
Foreign.
Foreign. Okay. Resident, do we tax?
Yes.
Yes.
Non-resident, do we tax?
No.
No tax because it has no source, right? Okay.
Yes.
Income derived in Ghana. What is the source?
Domestic.
Ghana.
Domestic.
Domestic source.
Domestic.
Okay. Domestic source. Residents. If you are resident, do we tax?
Yes.
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 If you are non-resident, do we tax?
Yes.
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 Yes. Because for resident, all incomes must be taxed, right? Non-resident, this one has a source in Ghana. It has a source in Ghana, so it must be taxed, right? So let's look at income received in Ghana. A remittance. What's the source?
Foreign.
It's a foreign
Foreign.
source. Okay. For residents, do we tax?
Yes.
Yes.
Non-resident, do we tax?
Yes.
Yes.
Resident. No, it doesn't. Foreign source, meaning he brought his wife sent him money in Ghana. The money was not earned here. So why should we tax it?
Oh, okay.
Received in Ghana from another country. That's why it's a foreign source. Do you get it? It has no, I told you non-residents are only taxed on income that has a source in Ghana, not so. So if it doesn't have a source in Ghana, then why should we tax it? Do you understand? So will we tax or will not tax it?
No tax.
Tax. Thank you. Okay. So let's see. Now let's look at income that is accrued in Ghana, right? It's accrued in Ghana. I bought treasury bills, interest accrued on those treasury bills for my company. What is the source? Domestic or foreign?
Domestic.
Domestic. For residents, do we tax?
Yeah.
Yes.
Yes. Tax.
Residents, do we tax?
Yes.
Yes, because it has a source, right? So anything that has a source in this country, non-resident will be taxed. But anything that does not have a source, non-resident will not be taxed. But resident, you see all incomes were taxed for resident, right? Meaning they are taxed on their global income. I hope that is well understood.
Yes, sir.
Well understood. Nice. Any questions so far? Or everybody's okay? Is everybody okay? So you remember I was telling you that section 3 talks about accessible income. Do you remember? So let's go to section 3. I hope you can all see my screen very well. Let me zoom it. Now, when you look at section 3, it talks about accessible income, and look at what it says. It says what? The accessible income of a person. If you hear person in taxation, okay? Anytime you are doing tax and you hear person, a person is either an individual, okay? A person is either an individual or an entity, okay? I said a person is either what? An individual or what?
Entity.
Entity. And if you want to break entities up, we can get a lot of them, right? The first is what? A partnership. The first is a partnership. We have a company. Please do that. Somebody's background is very interesting.
Yo, Oscar.
We have partnership, we have company, we have trusts, okay? We have trust, we have body of persons. So I can just add body of persons to company because under section 133, we put those body of persons under companies, but no problem. Let me just add it here, body of persons or exempt entities, okay? Then we have something we call a permanent establishment. And this is the main theme of the International Tax Force. Now, let me explain what this means. So if you are not an individual, then you are either of these, right? Somebody say, please, what's the difference between accrued in Ghana and derived in Ghana? Okay. Now, in simple terms, if I want to put it away, there are different ways they interpret it. But actually, when we say an income that accrues, it means it is passive in nature. Okay. And when we say income is derived, it is what? It is active in nature. Do you understand what I mean by that? So, before we continue with this, let's just help with that so that everybody will be fine. So let's say if income is derived, it means that it is active. You worked to derive it, right? So whether or not the source has ceased. So let's say if I work as my profession, right? My employment income is an active income because I actually work to generate it, right? My business income is an active income because I work to generate it, right? But when we talk about passive income is something that you do not work to generate directly, right? They mostly accrue in some account. Maybe you invested and it started accruing. So mostly passive income is mostly investment related, right? So let's say I did some software and the people are paying me royalties. It is passive in nature, right? I hope you are following. Somebody paid me dividends. It is passive in nature. It accrues. Somebody pays me interest. Passive in nature. It accrues. I sell my asset. Passive in nature. Capital gains. I didn't work for it, right? I'm getting rent income. I'm not working for it. My property is just the accruing rent. Passive in nature, right? So you see, all these things that you are seeing, that is what in international tax, the examiner even asks you questions on. So employment income is covered under Article 15. You'll be asked questions on it. It pops up a lot. Business income is covered under Article 7. I get it. And there are other categories of business, like shipping and air transport business, shipping and air businesses or international traffic covered under Article 8. If you are an artist like Sarkodie and the rest, you are also going to be working. You are an entertainer or you are a sports person. You same boat. Article 17 deals with this, right? So you see, all these types of income, the person works to generate them. But these ones, the person does not work directly to generate them, right? They accrue while this is derived. So this is active, this is passive. Is it understood now? Is it understood now?
Yes, please.
From an international tax perspective, that's how you should understand it. If you understand it this way, you are not going to have any problem, right? So the same way, let's say I came to Ghana, earned some money. I used that money to go and invest in what? Treasury bills, and I got interest. Is that passive in nature or is active in nature?
Passive.
Passive. I was employed to work as a chef.
Active.
Active. Nice. Okay. Now you see these articles that I've written there. This is the weakness of students, actually. Students do not like this. So there's something we call fees for technical services. It's just treated like royalties. They're in the same article if you're looking at the OECD model. If you're looking at the UN model, I know you're not familiar with it now, but don't worry. If you're looking at the UN model, it's built it under Article 12A. And these things, now they've seen that students are weak there. So this is what they will be focusing on nowadays, as I kept telling people. Passive income, you need to know it very, very well because passive income, students are not so used to it. And passive income is what people use to bypass tax authorities, do tax avoidance, dividend, interest, especially interest and royalties. People will not charge arm's length. It means that they will charge, let's say I can intentionally give interest to my, give a loan to my wife, right? And tell her and charge her 60% interest. After all, it's my own loan. Do you all agree? Do you all agree? Yes, but the thing is, does it meet the normal norm a bank will charge? Do you get it? Or anybody who acquire the same interest? It's not fair, right? So we just want fairness. And that is all you are learning in class. I hope that makes sense. Okay, so we come back to assessable income. And I said what? They said person. And anytime you hear person in tax, you are talking about an individual or what? An entity. Is that not what we learned? So we are saying that, okay, so if you are talking about entities, either a partnership, a company, a trust, a body of persons, or a permanent establishment. That is under Ghanaian tax law. Now, all these ones are common, but when we say a permanent establishment, what are we talking about? A permanent establishment is simply a business of a non-resident person in your country. What did I say? It's a business of what?
Non-resident person.
Okay, so if you have a non-resident person in your country, when let's say, if AB is a UK brand, right? It's a UK brand and it comes to establish a branch or an office in Ghana, okay? This branch that he has created becomes a permanent establishment. He has created physical presence in our country. So that is what we call that is what we call a Ghanaian permanent establishment. So you must understand one thing, that you cannot own a permanent establishment in your own country because it's a business of a non-resident. It means if you're a Ghanaian, can you have a permanent establishment in Ghana?
No.
No.
Why? Because it is the business of what?
A
The
resident.
resident.
Thank you. And this business of the non-resident, once you have a branch or office or workshop or something of that sort, or a place at your disposal in Ghana, what happens is that we treat it like any other resident company. So even in our new Companies Act, we've created a section for these kind of activities, which we call external companies, right? They shall file taxes like any other company. They shall register like any other company. They shall do renewal and everything, right? So you see, though they do not have their source in Ghana, they operate like what any other resident company will be doing. They can file taxes, claim withholding, and everything, right? I hope you are starting to get the basics. You see, it's not international tax is not far from your local law. And the reason why people fail most of the time is that they've completely ignored the local law and they just focus on the DTAs. The DTAs are also domestic laws. They are read together with our Income Tax Act. So that is the mindset I want to put in your head so that when you are learning now, you learn to familiarize yourself with what you have in your Income Tax Act. You see, everything I say, I back it with law. Yes, of course. So all these things we are seeing that we read, the domestic source, foreign source, they are all under accessible income and we'll be coming there. But I wanted you to understand person now. So who can summarize person for me as we just discussed? When we say person under tax or under income tax, what are we talking about? When we say person under income tax, what are we talking about? Person.
A person is an individual or an entity.
Okay. And can you go forward a little? You just say individual and entity. So throw more light on it.
Okay. A person is an individual.
Or entity. Then you go forward. Entities may include.
Entity may include partnership, company, trust, or body of person, NP, permanent establishment.
That's it. And what is a permanent establishment? As I explained.
The business of a non-resident.
The business of a non-resident in your country. So if a non-resident comes to your country, it could be that he's operating as an individual, brought his own things, came to sell. I get it. Though that one we assess him on an individual basis, but once he establishes a company or a branch, an office, right, it starts creating a permanent establishment based on the activities he carries out. So when we get to permanent establishments, you understand this better. I hope that is okay. So with that being said, I want somebody to read for us accessible income. Who is going to read for us accessible income?
Section 3, subsection 1.
Yeah.
Accessible income of a person for each year of assessment is the income of that person from any employment, business, or investment. Subsection 2. Accessible income of a person for a year of assessment from any employment, business, or investment is A. In the case of a resident person, the income of that person from each employment, business, or investment for the year, whether or not the source from which the income is derived has ceased, and B.
Please stop before you go to non-resident. You see from what we said regarding the systems of taxation, you realize that Ghana says if you're a resident, whether or not where you earn your income has ceased, it will be taxed in Ghana. Do you get it? So what it is telling us here is that this is what we call the worldwide income. Can you all see? So wherever you earn your income, Ghana does not care. Whether or not it has stopped or you still keep earning it, it will be taxed irrespective of wherever it came from. Do you get the idea? And is that what we learned at the worldwide tax?
Yeah.
Yes. So far as you are resident, you are taxed on worldwide basis. Makes sense? Are you starting to get it?
Yes.
Yes, please.
Okay. Now let's go to when you are non-resident and let's see whether it is what we learned. In the case of a non-resident person.
Okay. In the case of a non-resident person, the income of that person from the employment, business, or investment for the year, to the extent to which the income has a source in this country.
So you see, if you are non-resident, which income will be accessible? Income which has what?
A source in the country.
A source in the country. And what did we say about territorial tax? We said what? For the source system, we only tax non-residents on income which has what? A source in our country. Do you remember? And
Yes,
what are the categories of income which has a source in our country? Income that is what?
Accrued in Ghana or received from Ghana.
Or received.
derived
Derived in Ghana. Yeah.
right from Ghana. So
That is
accrued in Ghana or derived from Ghana.
Please, are we okay now? So you see section 3 tells it all, and then you see how it is relating to non-residents too. There are two systems. You're either taxing a resident or you are taxing a non-resident, and that is what you see here. Now, this is what I want you to look at carefully. You see, for non-resident, it has two sections. The first section is telling us that what? The income of that person from employment, business, or investment, to the extent that it has what? A source. Meaning there must be a source from which the income is earned in our country, either it is derived or accrued in our country. And look at the B part. The second part says what? Where that non-resident has a Ghanaian permanent establishment. Okay, so a Ghanaian permanent establishment automatically becomes a person in our law. So far as you create a permanent establishment under Ghanaian tax law, any income which is connected to that permanent establishment, irrespective of where that income is coming from, will be taxed in Ghana. So the permanent establishment now becomes like a resident person. That is why our Companies Act recognizes an external company, because that company acts like any other resident company will act like. I hope it makes sense. So though it's the business of a non-resident, but so far as it is in Ghana, it acts like any other company would do. Does that make sense?
Yes, sir.
Yeah, sure.
That is it. So can we continue? So the income of a person from an employment, business, or investment has a source in this country if it accrues in or is derived from what? This country, which we know already. Now, if you are assessing or you are determining the assessable income of a person or of another person, you shall determine it for each class of income what? For each class of income what? What's the word there?
Separately.
Separately. It means that anytime you are going to get somebody's income, you must get those incomes separately. So you can't mix employment with business. You can't mix business with what? Investment. You can't mix foreign income with local income. You must assess them separately. When you finish, you get your totals, right? I hope you learned something. So that was about it. So you see, international tax is just what? How our domestic law interacts with international transactions. I told you the aspect of the Ghanaian tax laws that deal with international tax. Yes, Oscar.
Yeah. Bill, with the permanent establishment, they use the word in the act. They said connected.
Yes.
How do we explain that?
Okay. So when we get to PE, you understand it more, but let me just throw light on it. Okay.
Okay.
International tax, you understand it when we use diagrams. So this is AB, right? I told you this AB. Let's say AB is a UK company. Are you getting? Then AB, this UK. AB comes and establishes a branch, which is AB branch in Ghana. Okay. Are you following? Now,
yes, please.
This branch now creates what? A permanent establishment in Ghana. Do you all agree?
Yes.
But we are saying that any income that is connected with this branch, I getting it, should be taxed in Ghana. It doesn't mean that the income of AB will be taxed in Ghana or no. If, let's say, this guy goes to do investment in the UK, okay? So let's say investment. This branch does investment in the UK and he earns some dividends. The question is the dividend connected to the PE? Oscar, is your question.
Yes, it's connected.
So where would it be taxed? Would it be taxed where the parent company is located, or it will be taxed where the branch is located?
It will be taxed where the branch is located.
Of course, that is what the law is saying, because it's connected to this PE. And this rule, we call it in the OECD and the UN model. Now it is being taken out of the OECD model, but we call it the force of attraction. We are saying that PE acts like a glue, okay? Anything that is connected to a PE will be taxed where the PE is located. And this rule, if you know it, you know almost all the articles, because all the articles have some sort of connection with permanent establishment. For instance, when we take employment, right? Let's say that this branch, I employ somebody from the main head office in the UK to come and work there. And so far as that person, so far as that person is a non-resident, right? His income will be taxed in that particular country. Do you understand? Is it understood?
Yes, please, it's understood.
I know. I'm in class. I'm in class. I called you earlier. I'm in class, so I called you earlier. When I'm done, Is it understood?
Yes, please. It's clear.
Okay. Sure.
It's clear.
So, what if, I get it? What if the parent company decides to remit some funds, okay, in the form of royalties to the Ghanaian branch? Is that income effectively connected with the branch? Yes or no?
Yes.
Okay, nice. So this is what
Yes.
the act is saying under section 3. I hope that is okay. And this is a key principle that we always use when we are dealing with permanent establishments. Okay, when we get to PE, you understand it better. PE, people do not like it. I'll make international tax very easy and simple for you. So there are various sections of the act that covers international taxes. We will not deal with them now, but we are going to cover them as we go along. But for now, you just need to know the various sections, and then you also be learning alongside, right? So you see, we have all these sections. And also, you see, apart from assessable income, there are other incomes which are also exempt, which have an international backing. For instance, there are some people who have entered into agreements with government of Ghana to come and work in Ghana, right? And the government has agreed that under some technical arrangement, they are not supposed to pay any taxes. You see, it's connected with international arrangement. 2, you can have shipping and air transport businesses. And it tells us that what? So far as you're operating a shipping and air transport business in Ghana, we can only grant you an exemption if only a similar exemption is given to Ghanaians in your country. We call it the concept of reciprocity. Okay, reciprocal, you do me, I do you, right? So if you show me love, I show you love. That's how this this one works. Do you understand? So it's like if you do shipping or air business in Ghana and you are not a Ghanaian company, the Commissioner General will exempt your income from tax if only a similar reciprocal exemption is granted to Ghanaians who do the same business in the country you are coming from. Do you understand?
Yes, sir.
I hope that is understood. So there are a lot of exempt amounts also there. Then we come to section 31 that talks about arm's length arrangement between associates. And this one has to do with transfer pricing. We have all these ones. They are anti-avoidance provisions, right? They stop people from what? Taking advantage of what? The loopholes in the tax law. Then we have residence, which is a key theme, but when I'm teaching you residence and Article 4, we are going to dive deep into residence from an international perspective and from a local perspective, right? But one thing that I want you to know is that your paper as international tax is centered around these areas, especially residence and permanent establishments and principles of taxation, okay? And how to claim foreign tax credits and other things. Those ones are covered under the Income Tax Act. But when we go to the Revenue Administration Act, the Revenue Administration Act has 2 main sections which are very important, right? Now, how does international taxation interact with our domestic tax systems? Okay. Now, domestic tax systems, the starting point of any study of international taxation is a broad knowledge and understanding of the domestic tax rules in various countries. You realize that international tax is not international, but domestic taxes across different countries, right? Now, domestic tax law governs the tax rate, what is taxable, how the taxable income is computed, and the tax compliance rules. So anytime you are even learning taxation, you always have to know what rate is applied to what income. What will be taxable? How do we compute that income? and the various tax compliance rules around it. Are we okay? So it is essential to know that the tax rules and how the rules are applied to cross-border transactions in what? A given country. I hope that makes sense. So under domestic tax laws, a tax liability will arise in a country if only there's a connection, which we call nexus. I said connection is called what?
Nexus.
Nexus. This is it. Nexus. Nexus means connection. Okay, so when you are talking about tax, we can only tax a transaction which has a connection to what? Something, which has a connection to our country or has a connection to a particular what? Transaction we are doing, a particular person. And this is what is causing a problem now in the digital economy, right? So it is creating a lot of tax challenges in what? In the digital economy. Who can tell me why? There's supposed to be a connection either with a particular country or with a particular person or with a particular transaction, right? Now, if I decide to sell or buy online, I can buy from the USA, right? How is that connected to Ghana? But I may be in Ghana. So you see, you cannot really define the nexus, right? And this is what creates a tax challenge in the digital economy now, the gig economy, which is now giving tax authorities a headache. So they are finding a way to try to curb this. And this thing will keep getting worse and worse because there are now new models, Web3 technologies, the use of NFTs, cryptocurrency, right? All these things are changing the dimension of how we learn tax and accounting. And this is causing an issue because nexus may now be difficult to identify. I hope everybody is okay. So under domestic tax laws, a tax liability will only arise if there is a nexus between the tax jurisdiction, which is the country, right? And either the taxpayer, which we call the tax subject, and the transaction that happened. So you see, that's what I summarized there, that anytime there's supposed to be a nexus, there is a connection between a particular jurisdiction, which is the country, a particular taxpayer, which is the person, and a particular taxable event or transaction, which is the tax object, right? So nexus is built from three perspectives, either the country, the person, or the transaction. So CPT, right? So these connections include factors such as where are you tax resident, where did the income source from, the place where the income is earned or derived, and the location of a particular asset. Okay, so please understand this, that our domestic laws are not so different from what you call international tax, but you have to understand that there must be a connection between what you want to do, I get or the person you want to tax, and that particular country. That is it. That's international tax. Okay, so you realize that everything is around source and residence, source and residence. That's the principle. Those are the connecting factors that create double taxation. So when you go to the exam and they ask you, what are the connecting factors? Okay, connecting factors that create double taxation. Okay, connecting factors that create double taxation. Okay, then we are talking about what? What are they? What are the two connecting factors that create double taxation? Answer my question.
Residence and source.
The residence and source principle, right? And what is the residence principle? I taught you. What's the residence principle? It says that what? It says that people will be taxed on what?
Worldwide basis.
It tells us that residents will be taxed on worldwide what? Income, right? And then source says that what? Non-resident will be taxed on what?
Territorial source.
Income that has a source, right? And you see, if you have decided to tax me on worldwide income and one person is taxing me at source, what happens? Double taxation, true or false?
Yes, sir.
Yes, because at the end of the day, what happens is that I've still been taxed twice, have I not?
Yes, sir.
Why not? Yes, I've been taxed twice. So let's understand that the definition of residence and source are contained in domestic law and often differ among countries as they are the connecting factors, right? So as national tax systems, laws and practices are not harmonized. They can and often do conflict, right? Because there are conflicts among the various tax laws because they were created differently. It can create conflict, right? Moreover, they may not be clearly expressed and may be subject to different interpretation. Interpretation is also an issue. For example, the meaning of the same terms and expressions may differ from one country to another, and these conflicts lead to double taxation and normally require tax treaties both to avoid them and to provide relief if needed. So tax treaties, tax treaties are normally created to do two things, right? To stop people from avoiding taxes and to also provide a relief against them. Like the example we looked at earlier, where Kofi went to the UK, made some money, came to Ghana, we can eradicate the double tax that this guy will pay using a tax treaty, okay? And actually, there are two main ways we eradicate double taxes, okay? Through either unilateral means, which means we use the provisions in our domestic tax law, where we provide a suitable tax credit certificate from another country, a suitable resident certificate. That tells the Commissioner General or the GRA that we pay that tax in the foreign country, and then they can allow us what? A relief. Are we okay? So that is it. Now, double tax treaties and the domestic law. One thing you must understand is that double tax treaties often override the domestic law. Why? Why is that so? Anytime there's a conflict between a DTA, an international arrangement, or a tax treaty, and our domestic law, if there's a conflict between the provisions, the DTA shall always take precedence. What did I say?
The DTA shall always take precedence.
I said anytime there's a what?
Conflict between the
conflict
law and then the DTA.
Yeah, so DTA shall prevail over what?
The domestic
over
tax.
the domestic law. Okay. DTA shall prevail over the domestic law where there's a conflict between the two, right? Where the two conflict, right? So that is it. Don't forget this. And Section 98(1) of the Revenue Administration Act also makes this clear. Now, I tell students that anytime you are dealing with a question that has Ghana and another country, always include this provision. And the thing is, in the marking scheme, there's always a mark for this. Do you get it? For me, I'm also teaching you how to answer questions. I said always include what? Always include what?
Section 98.
Include this provision. So you see, when you go to Section 98 of the Revenue Administration Act, it tells us that what? To the extent that the terms of an international arrangement, which is particularly a DTA, right, to which Ghana is a party, are inconsistent with the provisions of tax law in Ghana, the terms of the international arrangement shall prevail over the provisions of the domestic tax law. And is that not what we said? So DTAs generally override the domestic law, but there are some circumstances where the domestic law can also override the DTA. Okay, and those are rare case scenarios of what we call treaty overrides. Do you understand? I hope gradually you are getting it. So international tax is like that. We are gradually going. Okay. So we have seen basically what is international tax, various aspects, the principles that can create double taxation. We've understood just the basics of it, right? So why international taxation? Okay. The reason why we actually do international tax is one, to promote fairness, right? By imposing equal tax burdens so that people will not run away with money and they will feel like, oh, I believe that I've made enough money and then I can bring it to my country instead of running away too. It can enhance domestic competitiveness, right? Because we put fiscal measures in to promote economic growth, and it can help us obtain a fair share of revenue across borders, right? Also, it can bring about equitable balance between what we call capital export and capital import neutrality. And I'll come and explain these methods. But in simple terms, what does that mean? Tax neutrality is when we achieve, when we achieve a balance between our tax systems in terms of the liability somebody is going to pay. For instance, when we say capital export neutrality, we make sure that your tax liability that you pay everywhere is the same, so that you will not want to siphon funds and send it to another country. Do you understand? So for instance, let's take a simple example. Let's use Kofi again, right? This is Kofi. Okay. Remember the example we used earlier? Kofi went to the UK, okay, and made what? 100,000, right? 100,000 pounds. How much tax did Kofi pay? Kofi paid tax of 20%, right? Which is 20,000. So how much is the next amount that he will remit? Is it not 80,000? Okay. So let's see something. Now Kofi comes to Ghana, and yet this is what happens. In Ghana, Kofi brings the gross amount he received from the foreign country, which is 80,000. But in Ghana, how much tax does he pay? He paid tax at 25%, right? 25. So now he brings the whole 100,000. Sorry, I said gross, so 100,000. He pays 25. What happens now? So this 25,000 that he has paid, the law says that, okay, since we want to ensure tax neutrality so that Kofi will be happy, we grant him a tax credit, okay? And a tax credit reduces, he paid tax in foreign country. Let's say he provided a receipt. And we say, okay, then we are going to give you a credit against the foreign tax. So you pay 20,000 in the foreign country, right? So this 20,000 can be taken out of the 25. And then you have a net tax liability of what? 5,000. Can you see? So in effect, we are saying that to achieve what we call capital export neutrality, Kofi's tax liability, global tax liability, if we add all, it should be the same as what he would have paid domestically. So if he was in Ghana and earned the same 100,000, how much would he have paid? He would have paid 25,000 alone. True or false? True or false? If Kofi was only in Ghana and he earned 100,000, how much tax would he have paid on the 100,000?
25,000.
Only 25,000, right? Capital export neutrality ensures that even if you go elsewhere in the world, when we add up all your tax liability, it should still equal what you would have paid when you were only in Ghana. Let's see. When he went to UK, how much tax did he pay? It's not 20,000. When he came to Ghana, how much extra tax did he pay? Is it not 5,000? When we add all, don't you still get the 25, which you would have paid if you were only in Ghana? True or false? True. True. And this is what we want to achieve. That is what we call tax neutrality. Yes, Prince, your hand is up.
Yes, sir. So what if is the other way around, where UK tax is 25% and Ghana is 20%? So Kofi paid 25,000 in UK.
Yes. I'll come and explain that when we get to methods of relief. When that happens, we give him something we call an ordinary credit. Okay. So when we get there, we are all going to look at how to, we'll do all these calculations. I think our subsequent meeting, the next meeting, we'll be dealing with methods of relief and how to compute these methods of relief. Are we okay?
All right.
Yes.
Yes, sir.
Any other question? Any other question? So these international tax rules, where do we get them from? Those are the sources of international taxation. So international tax comes from various sources. We have what we call primary sources, and we have what we call what? Secondary sources. Are we okay? Are we okay? I said we have what we call what?
Primary source and secondary source.
Yes. Now the primary sources are the legislations themselves, right? And the secondary sources are the what? The other informational guides that we get from the primary sources, like the textbooks, right? They are secondary because we use the laws to create the textbooks, right? So the principal sources of international tax are the primary sources, which are the laws themselves. So we have what we call the Vienna Convention on the Law of Treaties, which is customary law that has been compiled into a document, right? Which we use mostly for the interpretation, or it governs tax treaties. Then we have model tax conventions. These model tax conventions are like frameworks we look on to draft a tax treaty. Are we okay? Then we have the tax treaties themselves. Then we have customary international law, right? So things that become law over practice over time, I told you. Then general principles of law. These ones and the domestic laws that we have in our country, they are all primary sources of what? International tax. We can even add regulation from supranational bodies like ECOWAS, OECD, from you know, all these international bodies, right? UN, EU, they are all primary sources. But the secondary sources are things like the practice notes, the guides, online research, the textbook, research guides, videos, journals, news, and current awareness, right? So they can ask you where do we get international tax from? And then you just have to openly tell the examiner this, and you should be fine. Is that okay? So those are the sources of international taxation. Okay. So the next area is somebody's back. So when we say policy issues, what are the two main issues that cause problem in international tax? There are two issues, right? One is what we call double taxation, and two is what we call tax competition. I said one is called what? One is called what?
Double taxation.
Double taxation
And the other is
and
called
tax
what?
competition.
And tax competition. So the main thing you are trying to solve in your exam is either you are dealing with double taxation or you are dealing with what? Tax competition. No matter where you are writing international tax in the world, whether it's CIT, whether it's CIOT, whether it's added, it's these two things you are either trying to solve. Okay, so most questions are either centering on DTAs and transfer pricing, which solve double taxation. I get it. And a bit of tax competition. Tax competition has to do with tax avoidance and evasion. So we are either solving somebody not paying tax twice or somebody paying tax twice. Do you get it? So the whole principle is to stop people from what? Paying double tax, and to also stop people from not paying no tax at all. Right? I hope that makes sense. Okay. Now, why do we have double taxation and tax competition? This is because of something we call tax sovereignty. Remember that every country is on its own. Every country is on borrow. Do you understand? Every country has the power to create its own laws, not so, administer them and collect money. True or false? True or false?
True.
Yes. So every
So
country has the power to create its own what? Laws, not so, administer those laws, and take money. Not so. And that is what we call what? Tax sovereignty. Okay. So you are a sovereign state. That is what it means. You have your own power to do all these things, right? So we are saying that, okay, if that is tax sovereignty, what are the types of tax sovereignty that we have? Or what are the types of sovereignty that we have, right? So there are three types. So we have what we call legal sovereignty. We have what we call administrative sovereignty. And we have what we call what? Revenue what? Sovereignty, right? So I told you every country has the right or the power to make its laws. That is what we call legal sovereignty. Administrative sovereignty is the right given to tax authorities like GRA, right? To administer. And revenue sovereignty is the what? The ability to claim and collect all the tax revenues. I hope that is okay. Now, because every country has this power or right, you know, the legal and administrative policies that they have are so different, and that is what may lead to this double taxation or tax competition in a country. Do you get it? Because the laws that UK has is different from Ghana. Maybe for them, if you earn money there, it will be taxed there. For Ghana too, if you earn money here or elsewhere, it will be taxed, right? Because of these two conflicts between these two sovereign states, it might create you paying tax twice or you not paying tax at all because of the two separate systems. I hope that makes sense. So all these problems that are caused is because countries' taxes are not the same. Do you all agree with me, or it's not clear? Do you all agree with me, or it's not clear?
Please come again.
I said because countries have their own tax systems, right? Because countries have their own tax systems and the tax systems are not the same, it can create double tax or double taxation or tax competition. Do you all agree with me?
Yes, please.
Yes, please, we
But they are
agree.
not the same. If maybe you, for your country, right, we only tax income that accrues in our country. And for the other country, the only tax income that comes from other countries. I don't think we will ever have a problem, right? Because at the end of the day, somebody can end up not paying tax at all. Do you get the idea? And somebody can end up paying two types. You pay here and come and pay here. It's because of the differences in tax systems. That's what tax sovereignty is mean. It's actually telling us that, okay, because we all have our own tax systems, it creates differences. And these differences lead to two policy issues. What are those two policy issues? What are those two policy issues?
Come again, boss.
I said,
Double taxation and tax
what
conflict.
are those two policy issues? Double taxation and tax competition. Are we okay?
Tax competition.
Yes, before we look at double taxation, let's just look at tax competition. What is tax competition? Actually, when I say tax competition, you should add harmful to it. Tax competition is not that harmful because it's part of any tax system. It is the harmful one that we want to curb against, right? So tax competition is the problem that cross-border activity can be used to evade or avoid taxes in the home country and push the tax burden below that of a purely domestic activity. Do you get it? So people will intentionally exploit loopholes in the various tax laws and try to do away with it. And mostly under international jurisdiction, you are going to see things like base erosion and profit shifting. You see things like income splitting, okay, shifting income, which is basically another name. They are similar. Transfer pricing, right? People use controlled foreign corporations. People use hybrid mismatch arrangements, okay? People use double dip leases, okay? Leases which will give you two deductions, okay? So there are a lot of techniques people have mastered over time, right? To, bypass tax. I get it. Intangibles. People use these things. Intangibles require intangible rights and royalties and other things. People exploit these to transfer income from a low tax jurisdiction to a high tax jurisdiction so that they shift the income and so they'll be paying smaller taxes, right? And that is what they are trying to do. When we say tax competition, because of how your laws are designed, it makes people want to bypass or look for loopholes in the law and what? Are you getting it? Reduce their tax liability. Does that make sense? And the reason why you are learning this as a student is because when you are doing international tax, you want to stop two things. One is double taxation. And two is what we call double non-taxation. Okay, and this double non-taxation is what we actually call fiscal evasion. Okay, evading tax systems, and that is the tax competition you are talking about. Right? We want to stop two things: you paying tax twice and you not paying tax twice. Because if you have worked in two countries, at least you should pay tax in one. Do you get the idea? If you don't pay tax at all, then there's something happening because a cross-border activity has happened and it is liable to tax. Okay then. Please, are we okay with tax competition? Can we move to double taxation? Can we move to double taxation? Any questions so far? Is everybody okay? So if you say you are okay, then in simple terms, what is tax competition? What is harmful tax competition? Thank you. What is harmful tax competition? What is harmful tax competition? Yes, from what I said, what is harmful tax competition? Eh? I'm listening. What is harmful tax competition? Nobody is talking, or you can't hear me. What is harmful tax competition? Nobody is talking. Or you can't hear me again. Am I audible? Hello? Oh, my network is.
Hello, Bill.
Am I audible?
Yes, we can hear you.
Yes, I asked the question, what is harmful tax competition?
So that's why.
Everybody is quiet. Oh, I gave you a simple definition. And even it's there, I told you when people try to evade and avoid tax, right? It harms the economy because you are pulling money, right? Instead of paying taxes, nobody is paying. You are bypassing the fiscal systems. And as a result of that, what happens? As a result of that, what happens? The government money. Maybe so. That not so. Is it understood? Is it understood? So can we move?
Hello, sir.
Yes, madam.
I don't know. With this tax evasion and tax avoidance, I know that one is permittable and the other one is not permittable. I don't know. Like we can, we can avoid tax, but we can't evade tax, or we can evade tax,
Yes,
we can avoid tax.
we can
Please,
avoid,
which
but
is which?
avoidance is part of tax plan.
Oh.
So
Okay,
tax avoidance
so in that case,
create artificial transactions, right? So with this one, you create artificial transactions or legit transactions to exploit loopholes, okay? So to exploit loopholes that you have seen in the law, right? So to exploit loopholes in
okay,
the tax law, okay?
okay.
And the
So
reason
in
why
that case, oh, sorry.
oh no, I'll continue. You said in
No,
that.
you please continue. You make your point. After maybe you making your point to make me understand.
So I'm saying that the main reason why you create artificial transactions is to exploit loopholes, either to minimize your tax liability, right? That's the
Okay.
main objective, to minimize tax liability or achieve a certain objective, right? A particular objective, which may not be necessarily minimizing tax liability, but maybe in some countries there are restrictions that, like, you cannot maybe transfer funds to your home country. So some people create artificial transactions. So let's say some countries, they tell you that the dividends you earn in that country, you cannot transfer all. You can only transfer 30% of those dividends. Okay. So that means 70% must be stuck in that country until maybe the following year before you can transfer. So what people do is that they will intentionally say, okay, they owe their parent company management expenses. You get it? So this management expenses, they'll charge it as an expense, but meanwhile, it is dividends in disguise. You get the idea?
Okay. Yes, please.
So it is not only tax that we do tax avoidance. We could only, though it's called tax avoidance because dividend definitely pay tax on it, it has other objectives which the person intending to do it also does it, right? And this is what multinational companies do all the time, because sometimes some countries will say, Apple, you know something, you pay less than 5% of your worldwide taxes. We will not allow you to shift your money from your bank account here to your country. You can only shift 20%. So they will create legit receipts and other things and transfer funds, like you are paying royalties to a subsidiary company. We are doing fees for technical service. And these things are all examples of transfer pricing, which is the main theme of harmful tax competition. And there's something we also call thing capitalization, right? Where companies become highly geared and they use interest. They take advantage of interest because interest is mostly deductible. They use it to take advantage of a tax position. Okay, so tax avoidance is legal. Okay, tax avoidance is legal, but excessive tax avoidance, the tax authorities do not allow it. Meaning, excessive tax avoidance could constitute evasion. Are we okay?
Okay. Yes, please.
Uh-huh.
Then I get the explanation why it's harmful tax competition. It's part of the harmful tax competition.
Yes.
Okay.
But still, me planning my taxes in this way could help me. Look at this. When you come to Ghana, under Section 10, interest is an allowable deduction, okay? Meaning you can deduct
Mhm.
interest that you earn. So far as it's you borrowed money and that money was used to acquire an asset, okay, or it was used to run your business, the interest on that loan is allowable. The law did not say the source of the money. It did also talk about the how much limitation it should be, right? So assuming there were no anti-avoidance provisions, people take advantage of this, telling you this, that, okay, if I had 100,000 profit, right? If I had 100,000 profit, and then I intentionally go for 2 million loan. Look, I go for 2 million loan from my friend, and then he charges interest at 10%. What will happen? That means if I less my interest, I'll have interest of 200,000 every year. True or false? And assuming my profit
True.
is consistent, what happens? I'll keep making losses. True or false?
Mm.
Is this not harmful?
True. It is.
Because I'll keep making losses, and in our law, we can also carry forward tax losses. Meaning I'll keep carrying forward tax losses every time because I keep making losses. Right? Because of some of these things, you see, the tax law now has sat down and said, people are doing this a lot. Now they've brought the concept of minimum chargeable income to tell you that if you make losses for 5 years, the previous 5 years, now we do not charge you on this because of some of these provisions. They've brought something we call anti-avoidance provisions, right? To tell you that, okay, if you make losses for 5 years, we are no longer taxing you on your profit, but we are taxing you on your turnover. 5% on your turnover now becomes your minimum chargeable income, which you are now going to tax on. So until the tax laws create or close the loopholes, people will always exploit the loopholes. Do you understand? But tax evasion is using dubious.
Yes, please.
Tax evasion means you are evading, you are escaping taxes using illegal means, like staying out of the registration system, keeping 2 sets of books, not recording transactions properly, right? Assaulting tax officers, giving false and misleading statements, right? You get it? Things which are illegal. That is what we call what? Tax avoidance.
Mm. Okay. Thank you, sir.
So that was tax competition. It's even good we have explained this. That was tax competition. So the final thing we talk about before we call it a day is what we call double taxation, right? And double taxation is the key theme, and that is what we'll be dealing with. In our subsequent lesson, we will dive deeper and look at. So double taxation, we are going to look at what it is. We are going to look at the types, okay? This is what we are going to discuss now before we call it a day. And then in our next session, we are going to look at the causes of double taxation, methods of relief from double taxation. And this is what we'll be looking at next week. Then we start by looking at double tax agreements. Okay. So basically, these are the things that we would be focusing on. Okay. So in simple terms, when we talk about double taxation, the word defines itself: double taxation, paying tax twice. Paying tax twice, right? You are paying tax twice. So what is it? It is a problem that cross-border activity is potentially taxable in more than one jurisdiction and may therefore carry a higher aggregate tax burden. So that is double taxation. So you paying tax twice, either in the same country, or even if it's not in the same country, I get to it. In the hands of two different taxpayers. So when we say double taxation, look at it from two perspectives, right? And I'll use examples to make you understand. So when we say double taxation now, okay, I said two perspectives. Some people's wrote down this quite honestly. Kindly this one. So we have what we call juridical double taxation. Okay? Juridical double taxation. We have what we call economic double taxation. Juridical stands from jurisdiction. So this juridical double taxation means country, are you getting it? So two countries have taxed you twice. Okay, so the subject is taxed twice by two different countries. So one person, okay, taxed twice by two different jurisdictions or two different what? Countries. Are we okay? So one person is taxed twice by two different countries. We call it juridical double taxation, hence jurisdictional. Sometimes we call it judicial because it has a judicial implication, right? So we are saying that, yes, Kofi, using the case of Kofi that we were looking at earlier. So this is Kofi, right? In the UK, what happened? He earned how much? Same example. He had £100,000, right? And how much tax did he pay? He paid 20,000. Do you remember? But because Kofi is a Ghanaian, when he comes to Ghana, what happens? He brings the whole 100,000, right? Gross, because you are a resident, is the gross we consider. So now this gross 100,000 will be brought to Ghana, right? And this same thing, we will tax it at 25%. So 25,000. This is double taxation. Can you all realize it? Do you all realize it? What kind of double taxation is this?
Juridical.
Juridical, right? So two different jurisdictions have taxed him on the same income. This same income has been taxed twice by two different countries. We call this juridical double taxation. Is that okay? Are we okay? Please, are we okay? I want you to be responding so I know you are okay. Was the example also clear?
Yes, please, it was.
So now we are going to economic double taxation, which is people usually do not get it. But economic double taxation is even simpler. Economic double taxation happens when one income, that one is not a person, one income is taxed in the hands of two separate taxpayers. One income is taxed in the hands of two separate taxpayers. Now, what does that mean? Let's take an example. We mostly use corporate income as a typical example, right? We mostly use corporate income as a typical example. There are complex examples though, but actually our DTAs mostly try to eradicate juridical double taxation and economic. Economic double taxation mostly is around passive income. People use it around passive income, right? And that is where mostly there are lots of complex issues. Actually, international tax is more complex when it comes to passive income, especially royalties, intangibles. Those are the issues that cause a lot of international headache because, you know, intangibles are difficult to define, even under IAS 38. You see, it says what? A non-monetary asset without physical substance, right? Identifiable non-monetary asset without physical substance. That identifiable, IAS 38 says it should what? It should either arise out of a contract or it should what? It should be separable. Now, this is causing a worldwide issue as now we have websites and other things, website costs under SIC 32. All these things are creating, just that most people are not very tax inclined. So these are not their areas. But if you go worldwide now, this is what is the hot shot. Intangible. Everybody uses intangibles now to bypass tax authorities. And it's difficult to define a brand. What is a brand? How do you account for it? I may overstate it in my books, right, to show a better position. I may understate the royalties or the benefits I'm getting from that brand. How would you know whether it's true? Because a brand is, do you all agree with me that a brand is so specific to my business? So if I tell you my brand is 100,000, can you find the same similar brand elsewhere to say that my valuation is wrong? Please answer me with a yes or no.
Never.
So you see, this is
No.
causing a tax panic. It causes a tax panic to the tax authority. So they are trying to say, okay, at least the benefit you are going to get from that asset, I get it, should have some sort of clarity or it should have some sort of what? Comparable elsewhere, right? So these are causing so much issues. And this is why international tax is so interesting. These are just the basics. But if you get the basics, I assume that once you get the basics, then when you dive deeper, it becomes more clearer and clearer. Are we okay? So let's understand economic double taxation. I said one income, two separate taxpayers. How does that work? Now, if this is my company, right? I have my profit before tax, let's say. you see that this profit before tax, let's say it was 100,000. What happened? Ghana will tax it at what? 25%. Is that not so? This profit before tax in Ghana is called a chargeable in. 25% becomes what? Is it not 25,000? So what's our profit after tax? Is it not 75,000? Okay. Now, assuming we decide to pay all as dividends to our shareholders. So this 75,000 will be paid as dividend. No be so? True or false? And who would they be paid to? Who would these dividends landing? Whose hands would this dividend landing? Whose hands are these dividends going to land in?
Shareholders.
The shareholders. Yes. Now, since it's going to land in the hand of the shareholders, you realize that in Ghana, for instance, this 75,000 that you pay to the shareholders will also be subject to dividend tax at what? Dividend withholding tax at what? At 8%, which will be how much? Which will be how much? You all agree? So what has happened? One income, right? It has been taxed 1, 2. Can you all see? Is it not the same profit that was taxed first? And now in the hands of the shareholder, that same profit which was transferred to him has still been taxed? True or false?
True.
So this is what we call economic double taxation. And economic double taxation can be within your same country or it could stem across jurisdictions, right? If this was in UK and you're a Ghanaian, they tax it in UK. When they transfer the dividends to you in Ghana too, they tax it again, right? So there are provisions in the DTA. Provisions in the DTA mostly do with juridical double taxation. But when it comes to passive income like dividend, interest, royalties, economic double taxation is kept to some level. That is why when it comes to dividend, for instance, under Article 10, right, it has a rule. If only it's not effectively connected to a permanent establishment, it is taxed twice. We tax it limited at the other country. So if this dividend is 8%, maybe in that country that you are being paid dividend tax, maybe they'll limit it to 5% when you own about 25% share. So you see, this has reduced the amount of tax you are paying. So this one, the provisions and the passive income help to deal with this economic double taxation. It won't eradicate it completely, but at least it will bring it down for you. Do you get it? Which is a way to relieve you from double taxation. So these were the types of double taxation and what double taxation was. We have actually looked at a lot of things in this short period. And then I think this is it. In our subsequent lessons, we are going to dive into a lot. I think next week we'll start with calculations. We'll look at how to compute income tax in Ghana, look at how to claim foreign tax credits, how to claim exemptions, and stuff like that. So we should be fine. Should be fine. Okay, that brings us to the end of our session. I hope it was not a bad session, though we didn't learn anything, but subsequently we will learn too. And I intend to complete the international tax syllabus in a quick manner. So by the next month, at least I think by next month to the next 2 months, within 2 months, you should be fully fit to answer any question that will be thrown to you. I don't want to waste so much time. Okay. So we'll cover and solve major questions, at least. Every major area, you should solve about 5 solid questions. And also every month you will have mock. Solid mock for you to practice well and pass. Okay, so if you have any questions, I'm open. Unfortunately, some people didn't join early, but you can access the video on our YouTube channel, okay? So just go to Prof's Training Solutions on YouTube. There are other videos too that might interest you. You can also go to the live section and you'll see this video there. Then you can watch it. Okay, then. Any question for me before we call it an evening? Any question for me before we call it an evening? No question. No.
Please, when will the study manual be ready?
Oh, you need steady manual print.
Yeah.
Lower the volume at your end. This week I've sent it to the press. They are yet to print, so they'll give me a call first. That is how it works. Because we do not print in larger quantities like the way other people making books for SHS and these people print thousands, 2,000. Usually it will have to reach your turn before they call you. But within this week, you'll definitely hear from me. I've placed the orders already. I hope that's okay. So they are actually
Yes.
processed. Okay.
Hello,
Is that
sir.
all? Yes, madam.
Please, I'd like to know. So let's say when answering examination questions, are we supposed to quote the arts and the article, like let's say
For
arts?
international tax, you need to. That one I won't lie to you. For international tax, without the articles, you lose significant marks. Do you know why? Because we don't know where your authority is coming from. For instance, you say that they ask you a PE, then you say in accordance with the DTAs, a PE is a place where a fixed place of business where the business of an enterprise is wholly or partly carried on. This you'll be marked. But if they are telling you maybe something like insurance under PE, you need to be able there are specific ones you should be able to put. The articles, not the whole article, but every article has some specific area that the examiner likes asking questions on. At least those major ones you should know. So for me, my students always there are some particular articles that always I'm stressing, like residence, Article 4, Article 4.1, what is there? Article 4.2, what is there? Tiebreaker rule for individual, Article 4.3, what is there? Tiebreaker rule for entity. These ones you have to know. Do you get it? There are some articles, if you just know them, it's not bad because those ones, the articles are not so important, like the paragraphs are not so important. But the ones that you need to know the articles and the paragraphs. For international tax, I won't lie to you, you need to know. But transfer pricing, don't worry yourself because it's the provision that is important, right? But for DTAs, you need that. And the articles
Okay.
are not so difficult to master too. Yes, please. I'm listening.
What is the difference between the articles and the arts?
Okay, so the double tax, because you are doing international tax, you'll be reading the double tax agreements together with the domestic law. So the act has sections, and the DTAs, the double tax agreement, have articles. Is your question answered now?
Yes, please.
Okay.
So in that case, if you want one, where do you get it? Or is in your book?
Yeah, everything is covered in the book. With the book itself is a self-tutor. That's how all my books are created. They are self-tutoring. So most people just buy them and depend on them and just come for intervention. But if you are the type who still wants class, and I'll advise you to still join class, then you get more points and add it to it. That boosts your chances of passing them. So that is how it works.
Okay, thank you, sir.
You are most welcome. Any other question before we call it a day? Okay. If we have no question, those who joined late, kindly refer to the YouTube channel. You get your videos there. And you can equally watch it and then make your notes. Until we meet next week, those who have been registered to, you can contact admin or contact me to register for this interesting and executive session. I want some of you to go and take a award. So very intensive class. Okay, I'll see you when you see me. Have a beautiful and good evening. I hope the session was not bad.
Not at all. Not at all. It was very impactful.
See you next week then.
Sure.
All right.
Have a good night.